In the last class, we have studied about sub-markets of money market. And I had mentioned to you all that most of these markets derive the name from the financial instrument that gets traded in that particular sub-market. So let us try to understand the different financial instruments which are traded in money market. The first one is Treasury Bill. This is a financial instrument through which government raises short-term funds to meet its short-term deficit. Presently, RBI issues treasury bills of 91 days, 182 and 364 days of maturity. The two types of treasury bills that were issued are ad hoc treasury bills and regular or ordinary bill. Just like a zero coupon bonds, treasury bills are issued at discount and hence bear no interest at the time of maturity. They are redeemed at face value at the time of maturity. The difference between the issue price and the face value is the return to the investors. Second one is certificate of deposit. It is a negotiable money market instrument which is issued in a dematerialized form or as a usance promissory note against funds deposited at a bank or other financial institutions for a specific period of time. The issue of certificate of deposit is guided by the directives issued by RBI from time to time. They are issued by all scheduled commercial banks and selected all India financial institutions. RRBs and local area banks are not allowed to issue certificate of deposits. The minimum amount that has to be invested in commercial paper is rupees 1 lakh and in multiples of rupees 1 lakh thereafter. The maturity period of certificate of deposit issued by banks is not less than 7 days and not more than 1 year, while the maturity of certificates of deposit issued by financial institutes is in between 1 year and 3 years from the date of issue. Loans cannot be availed against certificate of deposits and the issuing bank cannot buy back their own certificates of deposits before maturity. The third financial instrument is commercial paper. It is an unsecured money market instrument issued in the form of promissory note. The minimum denomination of commercial paper is rupees 5 lakhs and multiples thereafter. The maturity period of commercial paper is between a minimum of 7 days and maximum of up to 1 year from the date of issue. However, the maturity period cannot go beyond the date up to which credit rating of the issuer is valid. Only a scheduled commercial bank can act as an issuing and paying agent for commercial paper. Next financial instrument is commercial bills or what we commonly known as bill of exchange. It is a promise to pay a specified amount within a specified period by the buyer of goods and services to the seller of goods or services. The seller or the creditor draws the bill and sends it to the buyer for acceptance. After the buyer or the debtor or his bank accepts the bill, it becomes a marketable instrument. It is held by the drawer, that is the creditor or the seller, and generally a bill of exchange has 3 months maturity period. The seller is known as a drawer and the buyer is known as drawee. Another financial instrument is repurchase agreements with repo and reverse repo rates. Repo is a money market instrument which facilitates short-term borrowing and lending through sale based on collateral securities, especially treasury bills. A repurchase agreement involves borrowing for a short term by selling securities such as treasury bills to the lender, which is usually the Central Bank of India, which is RBI, with a promise to repurchase these securities at a predetermined date and a rate in future. The repurchase, that is reverse repo, usually occurs at a higher rate compared to the repo rate. So if suppose the treasury bills, for example, have been sold at rupees 5,000 to RBI at the time of borrowing, they will be repurchased at 6,000 or 7,000 at the time of repurchase or reverse repo. So that would be basically the rate of interest that you will be paying for that short period of time while borrowing from RBI. Next is cash management bills. Now, Government of India, in consultation with RBI, had introduced cash management bill as a new short-term instrument in 2010. And why was this introduced? So as to meet the temporary mismatch in the cash flow. They are very similar to treasury bills but are issued for maturities less than 91 days. So we all know that treasury bills is one of the instruments which government uses to raise short-term funds. But the minimum period for which you can issue a treasury bill is 91 days. So in case government needs money for less than 91 days of maturity, then cash management bills are introduced. Next is money market mutual funds. These funds invest money in high quality and very short period money market instruments. Basically, the liquid funds and ultra short funds for investors can be example of such funds. Some of the asset management companies offering money market mutual funds in India includes Aditya Birla Sun Life Money Manager Fund, UTI Money Market Fund, L&T Money Market Fund, etc. Last one is collateralized borrowing and lending operation, also known as CBLO. It was introduced as a money market instrument in 2003 and is developed by Clearing Corporation of India Limited, CCIL, which is a non-banking institution. It allows to borrow for a short term by providing prescribed securities, usually treasury bills, as collateral. The institution has to obtain CBLO membership to participate in CBLO market. Commercial banks, foreign banks, cooperative banks, insurance companies, mutual fund houses, primary dealers, provident, pension funds, etc. can participate in CBLO market.